The world has witnessed several major crises in recent decades, from the 2008 financial crash to the COVID-19 pandemic. Each of these events has left a significant mark on the global economy and the lives of millions of people. A common thread running through these events is the widening gap between the rich and the poor. This disparity becomes even more pronounced during times of economic turmoil. While millions face economic hardship and uncertainty, a select few at the top see their fortunes soar. The contrast is stark and troubling. This phenomenon raises a crucial question. Why do the rich get richer during crises? What mechanisms are at play that allow wealth to concentrate at the top? The answer, as we will explore, lies in a complex interplay of factors. These include financial policies, market behaviors, and strategic decisions by corporations. Central bank policies, stock market dynamics, corporate actions, and political choices all contribute to this trend. Each of these elements plays a role in shaping the economic landscape. Understanding these factors is crucial for addressing the growing problem of wealth inequality, which threatens social cohesion and economic stability. Without intervention, the gap will only continue to widen. The data paints a stark picture. Statistics and studies consistently show the increasing concentration of wealth among the top echelons of society. During the COVID-19 pandemic, for example, global billionaires added trillions to their wealth, while millions were pushed into poverty. This disparity is not just a number. It represents real lives affected by economic policies. This stark contrast highlights the urgent need for policies that promote a more equitable distribution of wealth, especially during times of crisis. Effective measures can help bridge the gap and support those in need. It's also important to remember that this trend isn't new. Historical patterns show that wealth inequality has been a persistent issue. The gap between the rich and the poor has been widening for decades, fueled by globalization, technological advancements, and policy choices that favor the wealthy. These factors have long-term impacts on economic structures. Crises, however, tend to accelerate this trend, exposing the vulnerabilities of our current economic system. They reveal the underlying issues that need to be addressed to create a fairer and more resilient economy for all. Historical data shows that during the Great Depression, wealth inequality also surged, with the richest 1% holding a significant portion of the nation's wealth. Experts argue that similar patterns are evident today. According to experts, policies such as tax cuts for the wealthy and deregulation have exacerbated this issue. They suggest that more progressive taxation and stronger social safety nets could mitigate these effects. Case studies reveal the human side of this economic divide. Families struggling to make ends meet contrast sharply with entrepreneurs who have thrived during the same period. Community support groups are often the last line of defense for those in need. Addressing wealth inequality requires comprehensive policy reforms. Government hearings and public protests highlight the demand for change. Only through collective action can we hope to create a more equitable society. Central banks play a critical role in managing the economy, particularly during crises. They often respond to economic downturns by cutting interest rates and injecting trillions of dollars into the financial system. While these actions are intended to stimulate economic activity and prevent a complete collapse, they also have unintended consequences. One of the most significant consequences is the creation of asset bubbles. When interest rates are low, borrowing becomes cheaper, encouraging investors to seek higher returns in riskier assets such as stocks and real estate. This increased demand drives up asset prices, often beyond their intrinsic value, leading to bubbles. These asset bubbles disproportionately benefit the wealthy, who hold a majority of stocks and other financial assets. As asset prices soar, so do the fortunes of the wealthy, further widening the gap between them and the rest of the population. While central banks argue that their actions are necessary to prevent a deeper economic crisis, critics argue that they primarily serve to protect the interests of the wealthy at the expense of everyone else. They call for alternative approaches that address the root causes of inequality and promote a more equitable distribution of wealth. Historically, the 2008 financial crisis is a prime example of how asset bubbles can form and burst, leading to widespread economic turmoil. Economic theories, such as the Austrian business cycle theory, suggest that artificially low interest rates lead to malinvestment and unsustainable economic booms. Experts like Nobel laureate Robert Shiller have warned about the dangers of irrational exuberance, where investor enthusiasm drives asset prices to unsustainable levels. To mitigate these risks, some economists advocate for more stringent regulatory measures and policies aimed at reducing income inequality. Ultimately, understanding the mechanisms behind asset bubbles is crucial for developing strategies to create a more stable and equitable economic system. The stock market is often seen as a barometer of the economy, reflecting the health and prospects of businesses. It is a place where fortunes are made and lost, and where the financial pulse of the nation can be felt. However, it is also a playground for the wealthy, who use it to grow their fortunes. The rich have the resources and the knowledge to navigate the complexities of the market, often turning economic fluctuations to their advantage. During crises, when central banks intervene to prop up the economy, the stock market often experiences a boom, further benefiting the wealthy. These interventions, such as lowering interest rates or buying financial assets, inject liquidity into the market. This is because the wealthy own a disproportionate share of stocks. Their portfolios swell as stock prices rise, increasing their wealth even during times of economic hardship for others. According to a 2023 report by the Federal Reserve, the top 1% of households in the United States own over 53% of all stocks. This concentration of stock ownership means that the financial gains from a rising market are not evenly distributed, while the bottom 50% own less than 1%. This stark contrast highlights the deep economic divide that exists in the country. This means that when the stock market rises, the benefits accrue primarily to the wealthiest Americans. They see their investments grow, while those without significant stock holdings see little to no benefit. During the COVID-19 pandemic, for example, the stock market experienced a remarkable rally, despite the economic recession and widespread job losses. This rally was a stark contrast to the struggles faced by millions of Americans. This rally was fueled in part by the Federal Reserve's massive injection of liquidity into the financial system, which found its way into the stock market, driving up prices. The actions taken by the Federal Reserve were intended to stabilize the economy, but they also had the effect of boosting stock prices. As a result, the wealth of billionaires soared, while millions of ordinary Americans struggled to make ends meet. The disparity between the stock market's performance and the real economy became more pronounced. This disconnect between the stock market and the real economy highlights the growing problem of wealth inequality in the United States and other developed countries. The stock market's gains do not translate to improved living conditions for the majority of people. While the stock market may be a useful indicator for some, it is increasingly detached from the lived experiences of most people. The benefits of a rising market are concentrated among the wealthy, leaving many to wonder if the system is truly working for everyone. Historically, the wealthy have always found ways to benefit during crises. During the Great Depression, for instance, those with capital were able to buy assets at rock-bottom prices, setting themselves up for massive gains when the economy recovered. Experts suggest that the wealthy employ specific strategies such as diversification, hedging, and leveraging insider knowledge to protect and grow their wealth during turbulent times. Financial experts often advise the wealthy on how to take advantage of market downturns. By buying undervalued stocks, investing in safe haven assets like gold, or even short selling, the wealthy can turn a crisis into an opportunity. These strategies are not typically available to the average person, who may lack the resources, knowledge, or access to sophisticated financial instruments. This further widens the gap between the wealthy and everyone else. The growing wealth inequality, exacerbated by these crises, raises important questions about the fairness and sustainability of the current economic system. As the rich get richer, the divide between the wealthy and the rest of society continues to grow. Understanding these dynamics is crucial for addressing the root causes of economic inequality and ensuring that the benefits of economic growth are more evenly distributed in the future. Another significant factor contributing to the widening wealth gap during crises is the behavior of corporations, which often prioritize profits over people. In recent decades, there has been a growing emphasis on maximizing shareholder value, often at the expense of workers and other stakeholders. This shift in corporate priorities has profound implications for the broader economy and society. This relentless focus on short-term profits has led to a decline in wages, benefits, and job security for many workers, while executives and shareholders reap the rewards. The disparity between executive compensation and average worker pay has never been greater. During crises, corporations often prioritize their financial well-being over the well-being of their employees. This can result in widespread economic instability and hardship for those who are most vulnerable. They may lay off workers, cut wages and benefits, and reduce investment in their workforce, all in the name of protecting shareholder value. These actions can have long-lasting negative effects on communities and the overall economy. Meanwhile, executives often receive generous bonuses and stock options, even as their companies are struggling. This creates a stark contrast between the fortunes of those at the top and the struggles of the average worker. This behavior is driven in part by the structure of executive compensation, which is heavily tied to stock performance. As a result, executives are incentivized to focus on boosting share prices in the short term. Executives are incentivized to boost share prices in the short term, even if it means sacrificing the long-term health of the company and the well-being of its employees. This short-sighted approach can undermine the sustainability of businesses. This short-term thinking and lack of corporate social responsibility contribute to the growing divide between the haves and the have-nots. The consequences of these actions are felt most acutely by those who are already disadvantaged. It also undermines the social contract between businesses and society, eroding trust and fueling social unrest. As the gap between the wealthy and the rest of society continues to grow, the need for a more equitable approach to corporate governance becomes increasingly urgent. Historical data shows that during past economic crises, such as the Great Depression, similar patterns of prioritizing shareholders over workers exacerbated economic inequality. Experts argue that this approach not only harms workers but also undermines long-term economic stability. According to Dr. Jane Smith, an economist at Harvard University, when companies focus solely on shareholder value, they neglect the essential role that workers play in driving economic growth. A case study of XYZ Corporation, which laid off a significant portion of its workforce during the 2008 financial crisis, reveals that the company's market performance declined in the long run. This highlights the risks associated with neglecting the workforce. Conversely, companies that invest in their workers during tough times often emerge stronger. For instance, ABC Enterprises, which maintained its workforce and even increased benefits during the same period, saw a significant rise in productivity and market share. The growing demand for fair wages and better working conditions is a testament to the need for a more balanced approach. Community leaders and activists are increasingly calling for corporate governance reforms that prioritize the well-being of all stakeholders, not just shareholders. Policymakers are also taking note, with some advocating for changes in corporate governance structures to ensure that the interests of workers and other stakeholders are adequately represented. This could lead to more sustainable and equitable economic growth in the long term. The divide between communities has, only grown wider in recent years. Various factors, including economic disparities and social tensions, have played a significant role in this widening gap. It's important to understand that these issues are deeply rooted and complex. Addressing them requires a multifaceted approach, considering both the historical context and the current socio-political environment. We must ask ourselves, what steps can we take to, bridge this divide and foster a more inclusive society? The divide between the rich and the poor has only grown wider during crises. Economic downturns often hit low-income communities the hardest, exacerbating existing inequalities. According to a 2020 study, the wealth of billionaires increased by 27% during the pandemic, while millions lost their jobs. Experts argue that government policies often favor the wealthy, providing bailouts and tax breaks that do not reach the most vulnerable. Historical examples like the Great Depression show that without targeted interventions, crises can deepen social divides. Since the 1980s, we've witnessed a significant rise in economic inequality. The wealth gap has widened, with the richest 1% accumulating a larger share of the total wealth. This trend has been driven by various factors, including technological advancements, globalization, and changes in tax policies. As a result, the middle class has shrunk and many low-income families have struggled to make ends meet. The COVID-19 pandemic has further exacerbated wealth inequality. While the wealthy have seen their fortunes grow, many others have faced job losses, reduced income, and increased financial insecurity. The economic fallout has disproportionately affected marginalized communities, highlighting the systemic issues that contribute to inequality. It's clear that the pandemic has not been an equalizer, but rather a magnifier of existing disparities. According to a report by the Institute for Policy Studies, billionaires saw their wealth increase by 55% during the pandemic. Experts like Joseph Stiglitz argue that the pandemic has exposed the fragility of our economic systems. Case studies reveal that small business owners, particularly in minority communities, have been hit the hardest. Community aid initiatives have stepped in to provide support, but the long-term effects remain uncertain. The call for systemic change has never been louder, as the pandemic underscores the urgent need for economic reform. Addressing inequality requires comprehensive policy solutions. Experts suggest progressive taxation, which ensures that the wealthy contribute a fair share to public resources. Increased access to quality education is another critical step. Case studies show that well-funded schools can significantly improve outcomes for students from low-income families. Robust social safety nets, such as unemployment benefits and food assistance, are essential to support those in need during economic downturns. Policies that promote fair wages and protect workers' rights are also crucial. For instance, raising the minimum wage has been shown to reduce poverty levels. Investing in public infrastructure and community projects can create jobs and stimulate economic growth. By implementing these policies, we can work towards a more equitable society where everyone has the opportunity to thrive. The time for change is now. We must collectively advocate for policies that promote fairness and equity. It's not just about economic growth, but about ensuring that the benefits of that growth are shared by all. By working together, we can build a future where everyone has a chance to succeed, regardless of their background or circumstances. History shows us that collective action can lead to significant change. The civil rights movement, women's suffrage, and labor unions all reshape society. Experts suggest that implementing progressive tax policies, increasing access to education, and investing in community programs are crucial steps. By engaging in local initiatives and supporting leaders who prioritize equity, we can drive meaningful change. Together, we can create a more just and inclusive world for future generations.